Welcome to the Contrarian Trader. This is Robert Desmond. It is Sunday, December the 7th, 2008. Folks, before we get into this week's The Week Ahead commentary, let's first recap last week's commentary and a couple of events that occurred last week as well. Let's go to a chart of the daily chart of the S&P 500 and take a look about what's happened over last week. My last commentary, I mentioned that I anticipated us seeing a pullback sometime last week, which we saw on Monday. And what led me to believe that we were going to see a pullback was for two separate reasons. One was for us to head higher, we needed to come back down to do a retest of the 741 level. Didn't have to come back down all the way. I said between 50 and 75%, or 50 and 100% of a retracement would make me feel comfortable that, okay, we protected this level and we're ready to head higher. Now, what happened was we woke up on Monday, huge down day, but the one thing that was bullish, I took a look at the end of the day, I said, wow, the volume wasn't there. You know, there was not much down volume. It wasn't really fear buying. And the remainder of the week was a fairly bullish week price-wise, and Friday was just the mother of all bullish days in my book. The only thing that's missing, and again, I'm always going to go back to this, folks, volume matters. It's so critical, I can't tell you. If you see large volume spikes, it's not simply short covering rally. You have some institutional money that's going in there as well. And it's the institutional money that you need to see come off the sideline. There are billions, if not trillions of dollars sitting on the sideline ready to get put to work. The U.S. Treasuries that most of these institutions are invested in right now, they're there for a safe haven. They're not making any money. And Friday was such a bullish day because we had the most horrible employment numbers come out Friday morning. More than 500,000 people were out of work in the previous month. Now, that's just simply horrible. That's terrible for an economy. But what's bullish for the stock market is for the market to take that news, sell off, and then rally back. What that's telling every technical trader and fundamental trader alike is that the market is oversold, and that reversal on Friday was a tell. That was telling us that this market's ready to head higher. All we need is some institutional money. And I remain bullish on this market because what I believe Friday's signal was going to do is I think you had fund managers over the weekend sitting around the table saying, you know what, let's put some money to work here, and that we might see a rise in volume this coming week. And if we get that rise in volume, and I'm talking substantial rise here, we need double Friday's trade for me to be excited about a breakthrough above the 900 level. And believe me, you're going to need that type of volume to break above 900. If they push us up here to 900 and even get us a little bit above there on this type of volume, it's going to fail. It's going to fail. Keep a tight stop loss order and get out. But if you're in this market right now, if you have your positions on right now, my strong suggestion to you is to keep your stop loss orders loose. And the reason why I say that is this, is that if the institutional money decides that they're going to want to put money to work, they're going to be putting orders down in there and block trades in the hundreds of thousands, if not millions. And you're going to have market makers that are going to be taking orders on the floor, and they're going to be looking for where the stops are. And when you put a stop loss order in, the market maker is able to see where you are at. They're able to probe you. And what they'll do is they'll gap the market lower in the morning for no reason whatsoever. Your stock will be opened up early in the morning, and of course the market maker he's going to front run his order, so he's going to want to. He knows he's got to fill an order for J.P. Morgan for 1 million shares of Microsoft in 20 minutes. So he's going to gap the market lower, buy his shares, and then buy 1 million shares of Microsoft. And what will happen is Microsoft will open lower. You'll get stopped out. The first 30 seconds of which you'll say, wow, thank God I got that. That was pretty ugly. And all of a sudden you're going to see Microsoft come rallying back, and you're going to be sitting there with a loss. and the market maker and JP Morgan is going to have their shares of Microsoft, and the market's going to take off. I've seen it 1,000 times. It's happened to me. Please have a higher pain threshold here, and that threshold should be, the first threshold is that if we break below this little trend line here, that's the first indicator that you may want to take some money off the table if we break below it, and you want to take everything off if we break below 740.102. But for now, as long as we maintain this upper trend line here, stay long. Don't let them shake you out. Okay? Put a stop loss order below Friday's low. That's a safe bet. If you want to buy stock on Monday, put a stop loss in below Friday's low, and that's a pretty safe bet. Let's take a look at the U.S. dollar. Now, the U.S. dollar appears to be forming a head and shoulders top here. You have the left shoulder, right shoulder, small head here, and I'm willing to bet that we're gonna break below this 86-cent level and come down to the 50-day moving average, which is 84.42. We'll see whether or not it's going to be able to hold that and rally back. But to be honest with you, with all the debt that this government's taking on and the spending that they plan on doing, I don't see that as an option right now. I think that the dollar is going to correct some. So if that does occur, keep an eye on your U.S. steels. U.S. Steel is setting up nicely here. Granted, there's no volume whatsoever here. So what you have in the making here is a bull trap if there's no volume. So you can buy shares on Monday if you want to get long commodities, a steel name. But keep a stop loss, right below this $25 level, and definitely just below the $70.71 level. It breaks this, believe me, it's going down to probably 10. So just be warned there. If you see the strength in the dollar, get out. I wouldn't even touch the commodity names, especially with oil. Last week I mentioned I was bullish of oil, and I still am bullish of oil in the long term. Last Tuesday, when the market did that rally, it opened up, it looked as if it was going to go lower than Monday's low. It didn't. It held and went higher. So it reversed on Tuesday. And what oil looked like it was going to do, it coincided with the low at the 39.16 level, which I said was your stop loss point if you wanted to go long the USO. Go long it, use a stop loss at 39.16. We were below that level, and I anticipated that the oil would follow the market and head higher. It didn't. It headed higher, and then it gave it all up. I got cute, and I went long the call contract, hoping to catch the rally, and I got stopped out of this call contract. I still have a very small common stock position. I have not added to it. What we have here is a reversal on Friday, which is I wouldn't necessarily call it Kiro, so it was a reversal, and it came on very high volume. So I think what we're seeing here is capitulation in oil, and if you go to the weekly chart, it's extremely oversold on a weekly basis. I mean, look at this. Weekly basis below 20 on an RSI. It's amazing. It's not going to stay there for long. So if we see weakness in the dollar, you can expect that oil is going to rally, the commodities are going to rally. So keep an eye on those. Folks, my time is running short here, so let's just take a look at the IWM. Now, IWM is the Russell 2000 ETF. Remember, the Russell 2000, that's the best and brightest of our future growth players. And if the Russell stocks do well, that means the market's going to do well. So if you want to see the financials do well, that means that the S&P will follow. And you want to see leadership out of the Russell 2000, because if these small companies are doing well, that means they have access to credit. And if they have access to credit, that means that the worst of this financial crisis may be behind us. So keep an eye on the IWM. It's critical. These are the next Microsofts, the next Googles, stocks like ISRG. That's the Russell 2000 stock. These names you want them to do well. Very critical. I mentioned last week that we had a 55% profit, I think 58% profit in Goldman Sachs. To clarify the record, we were stopped out Monday morning. We gapped down on Monday morning. So we stopped out with a 38% profit. Not bad. We got in when nobody wanted it, rallied up, We haven't gotten back into it. Goldman Sachs will be reporting soon. They expect a bad number out of this $2 billion number. I don't know what the Worcester number is, but I'd rather see it. I'd rather buy it after the news and see let somebody else take that risk. There's too many other opportunities out there at this point in time. So please, folks, if you're interested in becoming a Contrarian Trade Group member, sign up for the free 14-day free trial offer. Visit my site, and if you have any questions, please email me, subscribe to my channel, and leave a comment below. Thank you very much.